Yeah, I've got one, thanks.
Love what you did there. Appreciate it.
Hello, everybody. Thanks for coming out today on a beautiful fall morning here on the Drake campus. And we are the Financial Volatility, Impact, and Outlook panel. And I think we have a lot of good information going here today. I'm going to start with quick introductions, and we'll start on the far end with David Martin. David is Senior Vice President and Chief Operating Officer of Investments at F&G Annuities and Life. He oversees the company's $50 billion investment portfolio, hedging, and investment operations. David holds professional designations as an ASA, a Chartered Financial Analyst, and he received his BS in Mathematics from the University of Michigan. Next, we have Deanna Leighton, sorry, I said it wrong, Deanna. And she is Senior Vice President and Head of Allocation and Strategy for AB's insurance team. At AllianceBernstein, she is responsible for formulating insurance portfolio allocation strategies, overseeing daily portfolio management activities, and leading the insurance-specific cross-sector relative value discussions. Deanna holds a BA with a concentration in economics, also from the University of Michigan. So we have two Wolverines. I'm sorry for all the Iowa Hawkeyes in the room that we have here, competitors in the room, and is also a CFA charter holder. Our final panelist, Manuel Abacus, is an economist at Goldman Sachs. He is not a Michigan Wolverine. He holds a BA from Harvard and was a program for research in markets orientation fellow at Harvard Business School before coming to Goldman Sachs. To start our panel, and I'm sorry I should introduce myself, I am Tom Root. I'm Associate Dean of Academic Affairs and Associate Professor of Finance in the Zipperman College of Business. I've asked each of our panelists to start off today actually with providing kind of a broad introduction to their thoughts on volatility and what's happening in terms of market volatility. And we're going to start with Manuel, who is going to give us a broad overview of kind of the economic environment. Manuel?
Thanks, Tom. Thanks very much. Can people hear me? Yeah. I'll just give a broad sort of overview of how we see the economic outlook and what are the main risks around these views. So if we could go to the next slide. We see three main drivers of GDP growth for the US economy over the next year or two. The first one is tariffs. And so on tariffs, we sort of came into the year expecting the US's effective tariff rate to rise a little under 5 percentage points. By Liberation Day, if those tariffs that were announced had been implemented, that would have resulted in a 22 percentage point plus increase in the tariff rate. And that included, tariffs of 145% on China. Those posed very large downside risks to growth, to international supply chains. We actually had a recession baseline that lasted about an hour because the tariffs went into effect for about an hour, and then we had to take it off. That was the shortest recession call I think we've ever had, and hopefully that we will ever have. The tariffs that we're tracking now amount to something like a 15 percentage point increase in the US's effective tariff rate. That's still very large, but it's much smaller than those larger tariffs and should be less disruptive than the very high tariffs that were threatened for China at some point. And we seem to have narrowed the range of where we're going to end up. There's still some sort of negotiating tactics, dynamics going on in the US-China relationship, but overall the picture seems to have condensed around this sort of 15% percentage point increase in the US tariff rate. That's going to be a drag on growth. It tends to raise prices, tends to reduce consumers' disposable income, and also makes it more expensive for businesses to buy equipment. It imposes a bit of an uncertainty drag because of uncertainty around trade policy. And so we estimate that shaves off something like a point out of the level of GDP, something like 0.4 of GDP in 25, a little more in 26, as those sort of drags propagate through the economy. and then fading in the second half of 2026 into 27. The two other factors driving the growth outlook for us are financial conditions. So market risk sentiment is very resilient at the moment, and that should be a positive for growth. And fiscal policy should be stimulative. So we have the extension and expansion of several provisions of the TCGA that were passed by the Senate. We have increased spending by the government on the border and defense. Those things all stimulate the economy. We also have a few new sort of personal tax cuts, no tax on tip and overtime, that were passed with the Senate bill as well. On the sort of negative side, we have some benefit cuts that offset some of these more positive impulses. But fiscal policy will be a tailwind to growth in our forecast of the next year. And so when we put all of this together, the sort of combined drags are worth a few tenths on GDP this year. They kind of go into a more neutral territory early next year, and then slightly negative as the tariff drags remain, but the sort of fiscal financial impulses come down. That puts us in a growth view that's sort of weirdly normal, I suppose. We are tracking GDP for 2025 on a Q4 basis at 1.9%. We expect growth to be more or less in the same region, maybe pick up a little bit in 2026. And so if we could go to the next slide. But the fact that we have this growth view is weirdly normal, reflecting some very positive factors, some quite negative factors, means that the risks around this baseline are higher than usual. And so the US's unconditional probability of entering a recession, given that you're not in one at any given moment, is about 15%. Our recession odds at the moment are 30%, so double that, but still quite a ways below having anything like a recession or a contraction in the baseline. So that suggests a fairly benign outlook for growth, but with sort of fatter tails than usual. Turning to the labor market, I'll just say quickly, this is probably the sort of single most important risk that has led the Fed to start normalizing policy and lowering the federal funds rate at its September meeting. We expect it to lower the Fed funds rate again in October, and then in December, and then two more times in 2026. That's basically because of concerns, if we could go to the next slide, about labor demand weakening. Now, this is very difficult to gauge at the moment, especially with the government shutdown. We don't have updated data from the government. But the latest data we do have show a very sharp slowdown in job growth. If this were a normal kind of business as usual environment, you would definitely be extremely worried about this. We haven't seen a slowdown like this without the economy facing sort of much more serious problems ahead. The caveat now is, of course, we have a very large slowdown in labor supply because of a slowdown in immigration. And so that should lead you to expect, if there are few people coming into the country and joining the labor force, you should also expect that there should be fewer jobs added. Now, we estimate that over the last few months, the economy has averaged a pace of job growth about 25,000 jobs a month. That's still well below what we think when we just take the immigration numbers and we try to figure out how much would that warrant in terms of slow job gains. We think that would warrant a pace of 70K. That's what we call the break-even rate that would keep the unemployment rate unchanged. And so we're below the break-even rate. That means that there's less labor demand than labor supply in the economy. And that is another source of downside risk. One way we can get at this, if we could go to the next slide, is by looking at a number of labor market measures that control for the supply side. So you're trying to just gauge what the balance between supply and demand is. The most famous of these is the unemployment rate, number of unemployed people as a share of the labor force. You control for the number of people in the labor force, gives you a cleaner read. But across a number of other measures, quits rates, hiring rates, surveys of consumers and businesses on how easy it is to find labor or how hard it is to find a job. All of these things have softened materially and are now much softer than they were in 2019 when there was no inflation problem and the labor market was kind of at full employment. So we're undershooting maximum employment, which is one of the Fed's mandates. The other is inflation. And so that's sort of the key reason why the Fed is sort of moving rates to a more neutral setting. The other side of the Fed's mandate, of course, is inflation. So if we could go to the next slide, and there we're kind of sanguine. There is the tariffs will have already started leading to a bit of upward pressure on prices. The key thing to realize, though, is that the inflation rate is the change in prices, and tariffs lead to an increase in the price level. And so once that increase in the price level falls out of the calculation, you don't need to you're not going to keep that inflationary pressure going just from the direct effect of the tariffs. And so what that means is, sure, the Fed could tighten policy in response to a price level increase as a result of the tariffs, but then once that falls out of the calculation for inflation comes back down, they have to renormalize policy, just introducing volatility that you don't need into the policy stance. The key risk, of course, is that these price pressures broaden out beyond just the tariffed goods. So if we could go to the next slide, what becomes key is to track what's going on in inflation in the other sort of 2/3 of the basket. Around 1/3 to 40% of the inflation basket is goods. The other 2/3 to 60%, 2/3 is going to be services. And in those, what we've seen, so if we split that into two subcomponents, on shelter, on housing, we've seen spot conditions in rental markets be very favorable. So there is the balance between supply and demand now is such that rents are growing at a slower pace than they were before the pandemic, when, again, shelter wasn't an inflation problem. We didn't have an inflation problem. Things were running at the Fed's target, so we're undershooting that. So if anything, you have some disinflationary forces from this shelter component. And then the remainder, so non-shelter services, are going to be very labor sensitive. Now, I just told you that we're having a problem in that we have less labor demand than labor supply, that we're undershooting maximum employment. So from a wage growth perspective, we're probably not going to get sort of wage pressures that are very concerning from the Fed's point of view. So that leaves us with our view, if we go to the next slide, that the Fed will cut 3 times this year, including the September cut that they already did, twice more next year for a terminal rate of about 3%. The market's view is broadly similar. But we do think that, because recession risk is higher than usual, we have all of these moving parts on the growth picture and softer labor market. We do think that when we take an sort of expected value weighted average sort of out of the scenarios we think are plausible over the next couple of years, we end up with a slightly more dovish monetary policy view relative to where the market is. And then, since we're talking about risk, I'll just mention quickly a key risk that we're watching at the moment which is more of a medium-term risk than immediate sort of tomorrow problem, but is the US's fiscal trajectory. So the US is currently running a budget deficit that's, around 6%. We expect that to remain in the 6-7% region over the next several years. That reflects, a 2-3% primary deficit plus interest costs on the debt. Interest rates are higher now. That means you have more costs on the debt. That means the deficit is higher and the debt grows more quickly. And it's a very unusual fiscal position for the country to be in, given that even though we're not quite at maximum employment, we're also not in a recession. So at normal times, you'd expect the government to run something like a balanced budget, or at any rate something closer to a balanced budget than where we are today, where 6 or 7% of GDP is in government deficits. Going forward, if you project this out, so given this deficit outlook, and given sort of scenarios for interest rates and growth, if we could go to the next slide, and the one after. That puts the US on a very, very tricky debt trajectory. So we expect debt to GDP to reach all-time highs, go above 125% over the next year. Interest costs on the debt, so interest expenses as a share of GDP, will reach all-time highs after adjusting for inflation. That's the right-hand side, barring a very lucky draw in terms of interest rates, or much stronger growth, say because of AI, if that leads to extraordinary an extraordinary pace of growth like we haven't seen very often before, then we could get saved by that. But I was always told that hope is not a strategy, and so this is definitely something that will probably need to be addressed, and it's probably the single major macroeconomic imbalance that we have that we've had in the US over the last couple of years. So that's kind of our baseline outlook and where we see things today. Yeah.
Great, thank you. So very much good broad macro overview from Manuel. Really appreciate it. Next up, we're going to move to Deanna, and she's going to provide some thoughts on portfolio allocation as you're thinking about all the risks going on that Manuel just talked about, and also talk a little bit about private equity.
Sure. So Deanna Layton.
I was going to say that'd be the second set of slides for those.
Yes. While that's being pulled up. So I work for AllianceBernstein and manage money for insurance companies. And our parent company is Equitable, but we also manage money for third-party insurance companies as well. And what we really do is we take the inputs from Manuel and our macro team. We work with people like David on the asset liability management perspective. And then we also work with our dedicated subject matter experts on different asset classes and construct the right portfolios for insurance companies and really, customized investment solutions for them. Now, we tend to think about risk, and if we go to the next slide here, in 4 quadrants. So we think about it in terms of insurance companies really look for diversification, right? That's a big thing from our risk panel. Diversification of your general account helps insulate against market volatility. You can do that at an issuer level, right? So just having a lot of different investments in your general account. You can also do that at a more thematic level too. How do you take less correlated risk? And so insurance companies have been typically more exposed to corporates and commercial real estate. But ever growing, sorry, it might be a little hard to see. I see some squinting over here. Ever growing, we see more and more exposure to consumer as well as residential. And now what we do is we also want to think about how to construct those portfolios thematically based on different things that are going on from a macro perspective. So let's take the backdrop that we just talked about, that Manuel just talked about, right? You have jobs growth slowing, inflation not great, and also overlaying the fact that you're starting to see delinquencies tick up for consumers. And so from that perspective, we're actually becoming a little bit more cautious on consumer. We actually were pretty, quote unquote, overweight for the past couple of years and are kind of letting our portfolio exposures roll off and investing into the higher quality cohorts of the consumer exposure at this juncture, and shifting into more commercial and corporate just because of the macro backdrop. So it's on the margins, but shifting around and making sure that the portfolios are insulated, but it's also kind of in place for the thematics going forward. Turning to slide 3. So there's actually also been a very big shift in the insurance asset management space in particular. And so I think that a lot of this has to do with the evolution of private equity coming into the insurance space and owning a lot of insurers. And we're calling this at AB, we call it an insurance renaissance. They're a nice branded way to put it. But really what we're seeing is insurance companies getting more creative and more innovative on how they invest. And in the past, you thought of insurance companies as a little sleepy, and now it's kind of like they are at the forefront of alternative investing. I was just at one of the largest asset conferences earlier in this week. I've never seen so many insurance companies there, so many insurance asset managers there, and you could not talk about alternative investing, private credit, without insurance being in the conversation, because they're the capital behind private credit. So you see private credit in the Wall Street Journal and headlines, where is that capital coming from? In the higher quality cohorts, insurance companies. So in this, particularly in life insurance companies, we have a chart here that private has increased as a percentage of life insurance general accounts over the past several years. in kind of tandem with private equity ownership over insurance companies increasing. So there's a little bit of a marriage there. And it's not just the private equity owned insurance companies. I'm sure David will talk about this later, but assets drive pricing, particularly for life and annuity insurance companies. And so in order to be more competitive on the liability pricing space, you need to be more competitive in terms of what you're investing in and what illiquidity and securitization complexities you can pick up. And then finally on slide 4, in terms of life and retirement versus property and casualty. So life and retirement is definitely, in terms of the alternatives, private credit space, they have much larger portions of their general accounts in private credit. They can take on more illiquidity, and that's really what you're getting paid for in private credit. Now, I do think this is changing. So we've seen more and more property and casualty companies come to us asking for private credit exposure. And it's really twofold. In some cases, there's different cohorts of property and casualty. Some need more liquidity and some don't. There's also been an incredible amount of profitability in the property and casualty space, and then so their surplus has gone up and they have more capacity to take on some illiquidity, like we haven't seen before. So that's another avenue where we see, private credit and that flywheel continue to grow. So with that, I'll pass it to David.
Yeah,
Sure,
thanks. Yeah. David is going to come up with our third set here, and he's going to talk a little bit about asset liability management and some mitigation strategies for risk.
Yeah, thanks, Tom. And hopefully touch on some of the themes we've already heard. I don't know
have the
if you're going to
third
put my
set
slides
of
up.
slides up if we could.
They're going to be very hard to read, so it's not really, it's okay if they're not up there, but.
The sunlight is not in our favor.
Yeah, the sunlight's, yeah, exactly.
That was the last set. We need the
I'll
F and G slides.
Yeah. I can get started while those are coming up, but essentially what I thought I'd do was a bit of a 101 on kind of market factors that we follow, that we monitor, volatility in those factors, how that impacts an insurance company's balance sheet, income statement, and really volatility transmits through investment returns, capital and solvency, and if you are hedging, possibly hedging costs. So I'll talk about some of the risks of the you can go to the next slide. Some of the risks that we track, and then some of the ways we mitigate those risks. And that, so basically, oh wow, you got the PowerPoint that's doing the my animation, which I didn't. I thought you were going to use the PDF. Okay, no problem. Yeah, very fancy. I had this whole. Thought I was going to use a clicker and be able to do this, but. Anyways, I thought before I get into these market factors that you see on this slide, and by the way, these aren't the only market factors, but these are the ones that we really are focused on. I thought I'd just talk a little bit about volatility in general and the environment. So since COVID, and certainly the policy response, the recession due to shutdowns, supply chain distribution, that's really led to the inflation bump, which has already been talked about. Inflation really rose, and the Fed combated that with one of the steepest, fastest tightening cycle in history, raising rates about 500 basis points in 18 months. They also reversed most of the quantitative easing that had really kept volatility suppressed for most of the 2010s, the post-GFC era. So those two items, with a tightening of monetary policy, reducing liquidity, really started to increase volatility that we've seen over the last 5 years. That, and we've also had geopolitical tensions over the last couple of years, and then tariffs, as Manuel mentioned. But one of the other things that I think has really increased volatility more recently is technology. And by that I mean the speed of how information and market sentiment can move through the markets almost instantaneously it acts as an accelerant to volatility. So we're in that world right now. We've seen this over the last five years. I don't see this reducing, but we're just having to deal with much more volatility than we have over the last 20 years. So moving to the market factors that I want to talk about. So I'm going to combine interest rates and spreads and liquidity together, and the volatility in those market factors. So interest rate volatility, really I think of it as the speed of rate changes and the magnitude of those rate changes, which is really what introduces, can introduce sort of stress in the market. So rising rates, for an insurance company, steep rising rates can create unrealized losses in bond portfolios. Not generally a big problem for insurance companies because most insurance companies are buy and hold, and they hold their assets at book value. They're not marked to market. But if they happen quickly, you can see issues on the liability side. And as an annuity company, policyholders who have annuities have the right to surrender. And if rates are higher at the competitors, you will see an uptick in surrenders as policyholders look for a better rate, and competitors are also offering premium bonuses and things like that to draw policyholders. So when that happens, and you have these unrealized losses, there's a risk that an insurer, if it's not properly, has a proper ALM position or liquidity position, may have to crystallize some of those losses, which obviously flow through income and capital. On the flip side, when rates fall, you have liabilities that are they stay around a little bit longer, so maybe they have lower lapses than you would have thought. And then depending on what you have on your investment portfolio, if you have some floaters or if you have mortgage-backed securities that have prepayment risk, they can come back sooner than you expected. Or in the case of floaters, they could just go down in rate. So what you have when rates fall is you have reinvestment risk. And so you're reinvesting that cash flow at lower rates while your liability cost of funds may be relatively fixed. Now there are some products where you can reset renewal rates lower so you can kind of minimize that spread compression, but a lot of annuity products have minimum guarantees that get hit. And then it's also maybe not palatable to lower renewal rates because of its impact on distribution and volume going forward. So your hands are a little bit tied, again, if rates fall as well as rates rise. And I'll talk about ways to mitigate that risk. And then liquidity is very much related to ALM. I view it as a continuum to some extent. Volatility, you've seen various cycles of volatility popping. COVID volatility, we saw markets just seize up. There was no trading. Credit spreads blew out, but really nobody was even trading. So there was no liquidity. The only thing that was trading was liquid marketable securities. And then volatility can also have an impact on if you are hedging maybe some of your guarantees and your products with options or potentially if interest rate hedges. If they go down in value because of volatility, then you may see your counterparties require collateral calls, and you have to post cash, which is liquidity, could cause a liquidity stress if you haven't properly prepared for that. Just one example that everyone knows about, Silicon Valley Bank in 2023, it was their problems were kind of a combination of ALM and liquidity. They also had a depositor base that was very unique in that it was very concentrated in these venture-backed startups. So you had a very concentrated depositor base, and the bank had invested in longer dated maturities in those very non-volatile times in like the 2010s. So they're invested in longer dated assets, treasuries, mortgage-backed securities, very safe from a credit perspective. They had actually no credit risk, but they were taking a lot of ALM risk because their liabilities were demand deposits, which anybody could take out their money at any time. So they had ALM mismatch risk, and they were doing that because rates were so low, they needed that margin, that curve margin to make their money, to make their net investment margins. What happened? Again, back to the speed of information. These very sophisticated bank depositors, these venture capitalists, word spread quickly that Silicon Valley Bank was having trouble. They started to have to sell assets when people were taking their money out at a loss, which caused their capital ratios and their mark to market. And then it just kind of spun out of control because, again, with this concentrated depositor base, the tech-savvy folks that were doing things on social media that says, hey, this bank's in trouble, really just exacerbated the problem, and Silicon Valley Bank just didn't have the liquidity without selling those bonds at a loss, and it was kind of a death spiral, and they had to be rescued. So, and then finally, the two last risks that I wanted to just mention quickly: macroeconomic volatility, a recession. And a recession can be just because you're at the late innings of a credit cycle, but it also could be induced by a bubble burst, like an equity bubble burst. I think Tom's going to talk about the AI bubble a little bit later, real estate bubble in the GFC. But essentially, the risk to insurance companies is that weaker companies are either downgraded or may experience some defaults. And obviously, downgrades can impact the required capital that you may have to hold, and defaults will flow through to real losses. And then, in a big pullback, equities, if you're holding equities, can lose value. So all of these items can cause solvency issues. And then finally, geopolitical risk. War, obviously, Russia-Ukraine is a big topic. That war led to sanctions, so a lot of those investments became illiquid, uninvestable, written off completely. Middle East wars are also causing uncertainty. Tariffs and trade wars lead to instability. Certain companies that may be dependent on imports and exports can come under stress. One of the things that everyone I think is still watching is what's going to happen in China, Taiwan, right? That's a big sort of hot spot that you have to be careful, right? Because people are talking that things could happen there geopolitically. And then even recently, you've probably seen in the news, Argentina, right? That's been bailed out for the, umpteenth time over the last week. I think it's like 50 times in the last 50 years or something like that. So, those are things from a geopolitical perspective that you just have to be monitoring. So I'll move to the next slide, and sorry if I'm being long-winded here, but I'll be brief in the next section. Some tools to manage this. So interest rate risk, liquidity risk, asset liability management is super important. How you manage, your duration matching, cash flow matching of your assets and liabilities. This really mitigates the need to sell at an unrealized loss should rates rise, or it mitigates the reinvestment risk should rates fall. And then, you can also even, you can do this by buying derivatives or buying assets that just match, that you just buy investments that match your liabilities. But you can also use interest rate swaps and bond forwards, and you can use caps and swaptions to hedge out the convexity risk in your liabilities, because insurance liabilities are a little bit more positively convexed in the bond portfolios. So there's a lot of different ways to minimize interest and liquidity, interest rate risk. Unlike Silicon Valley Bank, insurance liabilities are much more predictable than bank deposits. They're features in insurance and liabilities that make them stickier. So a lot of times annuities have surrender charge protection or a market value adjustment, which if they were to surrender and rates are up, their cash surrender values go down, which is similar to how the bond portfolio goes. So it's kind of immunized a little bit. So these make liabilities quite a bit stickier. And then if you have payout annuities or pension risk transfer liabilities, those are basically non-surrenderable. So these are some of the features in an insurance company's liabilities that make it much more effective to manage that volatility in an insurance company versus a bank. And Deanna mentioned that a lot of companies are leaning into private assets. Well, private assets are great. They definitely have incremental spread. You can underwrite them. I think the credit is sometimes, we view it as better than public securities because it's very bespoke. You can understand the collateral, but they're illiquid. And that's one of the things that we're looking at is building in more risk limits around illiquidity and doing stress testing around illiquidity. So I think it's really important to have sort of a cap on how much illiquid assets you have, as well as having a minimum number of high quality liquid assets. And the other things you could do with liquidity, I think, to combat some of this is building in strong liquidity buffers with cash, T-bills, or other cash equivalents, making sure you have diverse funding sources like revolvers, bank lines, repurchase agreements, and then importantly, have a liquidity policy or a playbook, basically, that in a stress situation, you have a waterfall of sort of liquidity sources that you can tap. And then, I think to mitigate recession and geopolitical risks, Deanna mentioned this, it's very similar in that I think it's just important to have strong risk limits on assets, sectors, countries, illiquidity, as I mentioned, issuer limits, so limiting the amount you can invest in any one issuer prevents idiosyncratic risk. Be proactive about monitoring your portfolio. If you're feeling like you're towards the end of a credit cycle, you'll de-risk out of cyclical sectors, and maybe invest in high quality or up in quality defensive non-cyclical sectors. We underwrite our investments in stress scenarios to make sure that they're weatherproof in any different types of scenarios. And then finally, if you are going to invest in emerging markets, make sure you pick countries with strong rules of law and legal enforcement, stable governments, and stable economies. Those are really important. Not all emerging economies are the same, so you just have to be on the lookout for that.
Thanks, David. One of the things that I think all of our panelists mentioned was this recent volatility, especially in the spring. Manuel mentioned the 1 hour recession call. Is that how long it lasted? From the administration and the policies that have gone on. It seems like even though we still get a large amount of news coming into the cycle in terms of tariffs and things and potential tariffs, the markets have decreased the volatility in reactions to those. How do you guys feel about that? Is that a fair statement? And is that changing the way you view the geopolitical risk and looking at things today?
I can take that one. I mean, yes. If you think about, you typically with these headlines, you have a market reaction when they first hit. And then if you have more and more headlines around them, the market kind of figures out, okay, how do we analyze them, right? How do we think about different tariff scenarios and what that looks like on our corporate credit holdings, on all that sort of thing. So I think people kind of have gotten more comfortable analyzing the downside. That said, I think that there is a little bit of complacency with that. Like, I think that there is kind of a pricing to perfection at this juncture, and the full flow of tariffs hasn't really hit in terms of corporate earnings, what that looks like on a consumer balance sheet. Places like Walmart are only just now saying that the tariff impact is going to be passed on to the consumer. So that will hit. It's just about when. And maybe that will flow through asset prices, but there's the technical picture to remember, and there's just a lot of cash out there. And so as long as there's a lot of cash, the supply and demand dynamics are going to play out.
Anybody else? Your thoughts?
I was just going to say, from our perspective, from an economics perspective, one of the more surprising things about the tariffs this time around, and there's always, you see less of an impact than maybe you thought you were going to see, and you have to ask yourself, is that because most of the impact is still coming, or is it because you're wrong about the impact? But one of the things that we've definitely learned now, that's very different from the first trade war, is that in 2018, 2019, is that then you had a very sharp equity market reaction to what were tariffs that were, 5-10 times smaller than now. And financial market moves then feed and affect growth, which then feeds back to the financial market. So there's definitely a loop there that if you don't get the initial sort of panic or risk premium building in at the start, you're also going to get a little bit less of a macro impact that then gets that chain to be a little more mitigated. So it ends up going both ways, I think.
Yeah, I would just add, I think the market is thinking less about possibility and assigning probabilities. It used to be something, what's going to happen, like Manuel said in late 2018. Now I think they're actually assigning probability of things happening. So to some extent, they're just more discerning. The market's more discerning, and there could be some short-term blips, but I think in developed markets, they're short-term. But political rhetoric in emerging markets can have big impacts and structural impacts. So it depends on, I think, what markets you're talking about.
David mentioned a second ago that we were going to bring up artificial intelligence. I think it's something we have to talk about briefly, at least. Two different thoughts on AI that we need to think about. First, is the big run-up that we've seen recently in the S&P driven by the belief of the future economy with AI? And is that 1.9% growth that you talked about maybe underestimating the impacts long-term, and how does that look like? But just as importantly, on the day-to-day functioning, is AI changing the way we process information, make responses to the information that you guys do when you're doing your management strategies, and how is it going to influence that day-to-day operations? So what are your thoughts on this future technology? Is it going to have either broad, big economic outcomes or day-to-day functions in terms of what you're doing in your job?
I can start with the econ side. So we definitely think AI is a sort of big deal, and it's going to lead to high productivity, high living standards over time. The 1.9% number is for 2025 Q4. So it'll be a very short horizon to see AI have a big macroeconomic impact. Over the longer run, we definitely do see it boosting growth, productivity, and growth. I would say, these things always take longer than you think they will, and then they happen faster than you thought they could. And so I think we're probably going to see something like that it's going to take a little while. We definitely don't see it in the statistics yet. That's in part because of how some of the inputs to these things are accounted for in the GDP numbers. Some of it's excluded as intermediate inputs that are subtracted from the national accounts. But so it's going to take a little while, both from a measurement perspective, but also just from an economic perspective, because people have to figure out, how to integrate this into their business processes, how to manage the risks that come with that. You can't risk an AI like kind of hallucinating and wiping out all your code base, for example. Like I heard this happen to a business. You wouldn't want that. So you interact with the technology. It's definitely very impressive. It can do things that we couldn't have computers do only a short while ago. But it also is gonna take a little bit of time and iteration before those things get going. On a bubble side, we put out a colleague of mine put out a research report a week or two ago that was basically, AI capex is not too big, so we're very much on the not bubble side as of now. In terms of just the investment numbers, if you look at AI investment as a share of GDP in the US, you're still tracking, well below what you've seen in past technological sort of productivity enhancing cycles. And so, there's probably more to run there in just terms of the sheer amount of investment as a share of GDP. That being said, that doesn't mean that the returns on today's investments are necessarily going to be high. So, when the technology is changing very quickly, data centers and chips and servers that work today might be completely out of date, in 6 months, because the pace of innovation is so big, is so fast. And that can lead to sort of lower returns and kind of air pockets of times when sort of it doesn't return as much as you thought it would at start. But from an aggregate perspective, we think this is early innings. The economy is huge. It's going to take time for this to spread through, but it will eventually happen and deliver sort of quite sizable productivity gains in our view.
And I think data centers is such a hotly debated topic right now in terms of what we think about insurance companies investing. They really invest in debt, right? And the funding of data centers is a huge avenue right now for insurance companies across markets, in publics and privates. We see it come up everywhere in different types of asset classes. They're just tapping every single origination stream essentially right now. And there's a couple things around that. I think one, markets haven't really, for my feeling, markets really haven't processed how to think about it fully yet. I think you used to get a lot more spread for data centers, and that's come in a lot. as people start investing a lot more in that infrastructure. As Manuel said, it can easily happen where it just becomes not relevant from a technology perspective. And there's also a huge barrier from an energy perspective. So you need utility companies to build out and their grids in order to service the heating and cooling, really cooling, of the data center. So you need, and are we going to be innovating on energy first, or are we going to innovate on data centers first? Probably data centers, if you look at kind of the curve on innovation in those areas. So I think there's a lot of opportunity. There's a huge CapEx build that still needs to happen to support, everybody's daily use of ChatGPT and other things like that. But I think the jury's still out on what that looks like in terms of kind of the risks and downsides.
Yeah, and I can speak to how our company is thinking about AI. We're taking a very deliberate and methodical approach to AI, and my CRO told me I had to say that. So we have obviously governance for an insurance company, and having strong AI governance and governance over the models that you bring into your system. There's a lot of regulation on the forefront around non-discrimination and bias in underwriting. The NEIC has a model bulletin out, but some states have led on this, like Colorado, Texas, and California have their own rules around governance. We have a strong sort of intake process where if anything is coming into our system, we make sure there's strong oversight. Don't rely on third party for the most part. Unless there's a reason, and then there's an intake process for that. I think we view it as, in terms of like the culture of the company and how we're rolling it out, there's no doubt that it's going to have an impact on how we do business and process improvements, but we view it as an augmentation, not a replacement, if you will. You still need people to do a lot of the work, and it helps to, I think it'll help to reduce some of the manual tasks that we have and maybe create good automation. As far as its use in like the financial markets, I think I read an article yesterday that there was a CLO manager that is an AI CLO manager, but that, I don't know if you guys have heard of this First Brands, this auto supplier is going bankrupt. They had it in their CLO portfolio. So AI can't prevent you still from making bad mistakes. The other article I came across, which I thought was really funny, not funny, but interesting, was OpenAI is now soliciting and bringing in like MBA students, and you probably saw this article too, but they're bringing in they're bringing in people from like Morgan Stanley, because they want to train their models to build financial models for like the investment banking area, so that a lot of that manual work that's been done by junior analysts can be done by AI. And of course, now the junior analysts who a couple of years ago were complaining in the press that they were working 100 hours a week and they were, everything was like they were being overworked, are now saying, hey, wait a second, we want our jobs and we need our jobs. But their point actually was that not so much that they were worried about losing their job, they're more worried about when you do that grunt work, that's really where you learn the business. And so a lot of that work, you still need to be doing it. So I guess my point is you don't want AI to take away the work that is really important for somebody who's learning the industry, because you do learn, even though it's grunt work, you do still learn a lot about it. So
that's a great point, David. I think we're going to be running in time, so I wanted to see if we have any audience questions before we go and give the audience a chance to ask the panel if they have anything. If not, I can go forward. Anybody?
Anyone?
Thank you for the panel discussion. On the last point on the AI bubble, I was waiting for extreme views from the panelists, but you're all having some consensus there. So none of you really said that the AI bubble is real. And my questions are, what is the hypothesis that it isn't real? Primarily because the productivity numbers, all of it, aren't yet panning out, and the investments are just accelerating at a robust pace. And yet, there are massive risks with the newer AI techniques that we know. They're not there yet, right? In terms of agentic capabilities, the agentic browsers that are being launched, they bring in massive risk from a cyber attack perspective and other aspects of it. So I wanted to know your perspective in terms of if that scenario were to be real, then what does it mean?
So yeah, I mean, you could definitely end up with, and I think this is the process of figuring these things out. It took years before, like, after the introduction of computers for this stuff to show up in the economic statistics. Like I said, any economy, but the US economy in particular, is huge, and it's like millions of interactions and all of that. So it's going to take time. And yeah, it could definitely be, I think, if you consider the extremes, that it could definitely be like a complete dud, where it kind of, does what we can do already and introduce a bunch of risk, and so it's not worth it. I think having interacted with it, it seems to be able to do at least some things better, like quantifiably better than the infrastructure that we had, the technology that we have before. I would just say the other side of the risk, which is like this AGI stuff. I mean, that's also like a very, very, very sort of right tail scenario that some of the people involved in this technology think is at least plausible. So there's definitely a very, very wide range. I don't think the market's pricing anything close to like a sustained productivity growth, acceleration, sort of, even if not AGI, anything close to it, because you'd be seeing, much wilder moves than the kinds of things like, somewhat elevated valuations that we're seeing now. So yeah, I think there's definitely the risk. I think the more salient risk or plausible risk that I kind of think about, that jumps to mind to me, is just kind of getting the timing wrong of like, yeah, like these things today, the technology as it exists today, even if it's very promising, it's going to take a lot of work to integrate that into processes and to manage the risks associated with it. And that people just kind of, it's very easy to interact with ChatGPT and think this is going to change everything. I don't need anybody anymore. I can just do it on ChatGPT, and then you actually go and do it. It's a bit harder. It can still make you much more productive than you were before, but it takes a bit longer. And so I think actually, getting the timing right. And if you look at history, the dot-com bubble, it's not, those companies, Microsoft did very well in the end. So it's not like the overall thesis was wrong, and it's not that those things didn't end up being very good for productivity and very widely used in business. It's just that getting the timing right is very, very tricky, and financially that really matters, because you're sort of pulling forward to the present a bunch of discounted cash flow, and like getting that right is the tricky thing. So I see more the risk there. It seems pretty clear to me that this stuff is able to do things that we couldn't do before.
Yeah. I think the allusion to the dot-com bubble is spot on, because we had a bubble. There are some companies that had bad ideas and they were overvalued, but also there's huge innovation, long-term increased productivity, and from the dot-com to now, like, look at the S&P.
All right, excellent. I think we are probably at time or past.
Can I add one quick question?
Yeah.
So also for Manuel. The question is, I guess your projections were base case. What does a non-base case projection look like? And I specifically looking at the U.S. debt overhang and the fact that the 10 years hovering around 4 still, which goes to Bill Gross's quip that the bond investors look at the U.S. still as the least sturdy shirt in the closet. Now, if that, and I don't know how long that's going to be, it's amazing to me that it's still continuing, but what does a non-base case scenario look like specifically with respect to that? I don't know, 10-year at 6.5 as opposed to 4?
Yeah, I mean, probably not gonna, shouldn't put specific numbers on these things. There are associated probabilities. You need to specify a lot of distributions to be able to do this properly. I think the salient thing to me about these kinds of things is that they are nonlinear. That that you're not worried until you're worried, and then you're very worried. I mean, and so there were some technical factors that interfered with this, but the Liz Truss episode in the UK springs to mind, where there was a lot of stress that all of a sudden there was a political catalyst. They presented a budget that the market saw as non-credible, as kind of potentially irresponsible policy, and there was a just shift higher in yields. You could see something like that. It seems, at least to me, seems plausible that if you have a world with a ton of investment demand, a budget deficit that's growing, and just a little bit more risk around central bank independence, maybe a bit more risk around inflation. So if you're talking about nominal liability of the U.S. government, that all seems to point in the direction of some risk to the upside. But when exactly the markets kind of force the politicians to kind of face the budget problem, I think is kind of trying to forecast a black swan or a kind of non-linear sort of dislocation. It's very, very difficult to figure out exactly what the trigger for that is. What I tell people is, what can't go on has to stop eventually. And with this, it's not so much that, there's nothing imminent that depends on the US getting its fiscal house in order. It's a little bit more like you're eroding, and central bank independence stuff is the same. You're eroding the foundation of the house, and the weather is good outside. And that's fine, But if the weather turns, then, that you will have, for example, if we go into a recession, you'll probably have less fiscal space to support the economy in a recession. You'll probably have, long-term rates come down less than they otherwise would. If the economy goes into a recession, that puts problems on the government if it tries to increase borrowing to stimulate demand. So I think a lot of these kind of if you get into bad times, things will get more difficult. Is where will come into sharper relief, barring just all of a sudden you wake up one day and there's some kind of dysfunction that leads people to worry more. But I don't think that that's the kind of dynamic that we're likely to see in the treasury market. I think what you're more likely to see is just you really feel the pain if you ever need to increase your borrowing and then you can't, and you really feel the pain that if we get an inflation burst, then if your central bank isn't as independent, then that might cause you issues. And that's kind of how I see those things sort of more plausibly playing out. And absent that, you'll kind of be running into business as usual, maybe a little bit of upward pressure on longer term rates, but nothing that kind of puts you off the track.
Thanks. I think we need to end on time. I'd like to thank our panelists. It was a great discussion. And we'll move on to the next panel.